Welcome to Supernova Stock Watch. Investors often experience the dilemma of wanting high prices when they sell, but not when they buy. There are times when this dilemma causes investors to wait for a dip in prices, potentially missing out on an entitled rise in the meantime. It's very tempting to try to time the market when things are going well, and buy low, but the markets can be unpredictable, especially following a period of volatility. It's always better to have an investment strategy in mind, and stay calm with your goals rather than make risky decisions. To get over your fear of the market, here are 2 investment practices that can improve your odds for an extended period. You can either dollar cost average, or value average into your portfolio stock picks. Understanding dollar cost averaging. Dollar cost averaging is when someone invests a set amount at regular intervals. It's usually more often than yearly, more likely bi-weekly, monthly, or quarterly investments. For example, dollar cost averaging is a widely accepted investment strategy that can suit investments in stocks or exchange-traded funds. It's considered to be a stabilization strategy, and is used to avoid emotional reactions when there is the perception of uncertainty around your investments. In a broader sense, dollar cost averaging can include automatic deductions from your paycheck that go into a retirement plan. Dollar cost averaging is a good strategy for those who are not always comfortable investing their money in the stock market. Putting your investment into the market all at once means that you have no control over timing, and could buy when prices are high. The potential risk of this price drop is called timing risk. If you use dollar cost average, the worry of this lump sum going into the market in one go, all at once disappears. So not only does it lower your risks and effects from a single market move, but spreading them out over time will also allow for less volatility and better returns. For example, suppose that you invest $1,000 each month for 4 months, as part of a dollar cost average plan. If the prices at each month's end were $40, $30, $35, and then $25, your average cost would be $32.50. If you had invested the whole amount at the start of the investment, your cost would have been $40 per share. In a dollar cost averaging plan, you can avoid the timing risk and enjoy the low cost benefits of this strategy by spreading out your investment cost. Value averaging. Another popular strategy is value averaging, which buys more shares on the down days, and less during the high days. This can reduce volatility and risk exposure overall. Value averaging is conducted by calculating predetermined amounts for the total value of the investment in future periods. You are then investing in matching these amounts at each future period. For instance, say you determine that your investment value will go up by $500 each time you invest. Suppose you'd invested $500 at $10 per share in the first investment period, and you calculated that the value of your investment would rise to $1,000 in the next period. In that case, you decide to invest an additional $500 at $10 per share. If the current price is $12.50 per share, your original position is worth $625. 50 shares at $12.50, which means you only need to invest an additional $375 to get the total worth of your investment to equal $1,000. This is done until the end value of the portfolio is reached. As you can see in this example, you have invested less as the price rises, and the opposite would be true if the price had fallen. For this reason, instead of investing fixed amounts at regular intervals, a value average strategy invests the money in the whole portfolio at each point in time. Here is an example of the 2 different strategies. When share prices drop, you can buy more shares, and end up getting more shares as a result. This happens with dollar cost averaging as well, but it is less significant. Most of the shares have been bought at very low prices, thus maximizing your returns when it comes time to sell. Research shows that value averaging can provide greater returns than dollar cost averaging while still reducing the level of risk. In certain circumstances, such as a sudden gain in the market value of your stock or fund, value averaging could even require you to sell some shares. Overall, value averaging is a simple, mechanical type of market timing that helps to minimize some timing risk. Choosing between dollar cost average and value average strategies. In using dollar cost averaging, investors always make the same periodic investment. The only reason they buy more shares when prices are lower is that the shares cost less. On the other hand, value average investors buy more shares because prices are lower, which helps to ensure that more significant investments can be made on lower priced stocks and maximizes cost savings. Value average requires investing more money when share prices are lower, and restricts investments at higher prices. This means it generally produces significantly higher investment returns over the long term. All risk strategies have their trade-offs, and dollar cost average is no exception. There's a chance you'll miss out on higher returns if the investment continues to rise after the first investment period. Waiting to invest also means you're missing out on potential returns that your money could potentially earn. However, in the event of a sudden downturn in the markets, you will be spared the brunt of market volatility, and need not worry about your portfolio's value plummeting. Some investors who engage in dollar cost average will stop after a sharp drop, cutting their losses. For these investors, dollar cost average just doesn't pay off. They miss out on the main benefit, choosing to purchase more significant portions of stock in a declining market, allowing for more significant gains when the market rises. When using a dollar cost average strategy, it's essential to figure out if the reason for the stock's drop was material to your investment. If not, you should probably buy some more shares at an even better valuation. It may not be straightforward figuring out the right length of time for when dollar cost averaging should be used. If you are dispersing a large lump sum, you may want to spread it over 1 or 2 years, but any longer than that may result in missing a general upswing in the markets, as inflation chips away at the actual value of the cash. In addition to purchasing shares at set intervals, when using dollar cost averaging, if the stocks you are buying happen to pay dividends, you can reinvest those dividends in the underlying shares, using the dividend reinvestment plan, called the DRIP strategy. DRIP can be thought of, essentially, like dollar cost averaging on autopilot. For value averaging, one potential problem with the investment strategy is that an investor might run out of money in a down market, making the more significant required investments before things turn around. This problem becomes substantially worse when the portfolio has grown more prominent, as your required investments to stick to the value average strategy will be much higher. Avoid emotional investing. These types of strategies can be implemented in any market condition. In a downward trending market, investors purchase shares at continuously lower prices. When the market is on an uptrend, previously held shares that you still have in your portfolio are generating capital gains, and you buy fewer shares when the share price is going up. Dollar cost averaging and value averaging are strategies that function on consistency. It's essential to stay the course and avoid modifying the established strategy unless a significant event warrants revisited changes. Diversification is a principle that can help you stay rational and calm during the more tumultuous times. Not only does it protect you from losses, but it also lets you benefit from investment opportunities in the future. After all, there are only a handful of times in history when all markets have moved in unison, and diversification provided little protection. In regular market cycles, diversification protects because gains in others offset losses in some investments. Diversifying your investment portfolio can take many forms. For one, you can invest in different industries, different geographies, or even alt investments like real estate and private equity. It's a good idea to have diversity in your investments. This will protect you from fluctuations and may provide you with long-term benefits. Investors are under a lot of pressure, and it's hard to stay calm and composed. You still need to manage risk, or else you could regret your investment choices. You understand the risks you take when investing, and your tolerance for these risks is necessary for making rational decisions. It's crucial also to understand what's driving the bullish or bearish trends in the markets. The bottom line: the dollar cost average approach is easy to follow and implement, which is an advantage that others don't have. Dollar cost average also appeals to investors who aren't comfortable with the higher investment contributions sometimes required for the value average strategy. For investors seeking maximum returns, the value average strategy is preferable. The justification of using dollar cost average versus value average is dependent on your investment strategy. If the passive investment is your niche, figure out what kind of portfolio you like and invest the same amount each month or quarter. If you are dispersing a lump sum, you may want to put your idle cash into a money market account or other interest-bearing investment. In contrast, if you are feeling ambitious enough to engage in a little active investing every quarter or so, then value averaging may be a much better choice. In both of these investment strategies, we are assuming a buy and hold methodology. You find a company or fund that you feel comfortable with and purchase as much of it as you can over time, selling it only if it becomes overpriced. If you are looking to buy low and sell high in the short term by day trading, then dollar cost averaging and value averaging may not be the best investment strategy for you. However, if you take a conservative approach, it may provide the edge you need to take advantage of the market volatility. I enjoy sharing my insight with you and helping both of us become better traders and investors and finding some level of success. You have made it to the end of my video. Thank you for watching. Please check out my other videos and the description for great deals and sign-up bonuses.